We felt scattered. I thought, why do we have two different financial advisors? One's doing one thing, one's doing another thing.
We felt sometimes like we were being guided in directions to spend extra money on things that probably weren't always necessary for us.
I would not know for sure if I should put my money in here or put it in there. Should I buy this real estate?
I don't know what to do with this money, and I don't want to just blow it and spend it.
We were concerned about our financial health and just wanted a better financial picture.
And so when Earned came onto our radar and we sat down with our financial advisor, it just felt different.
I think a physician specifically should look at Earned because the focus is on our field. They know what a physician goes through at different phases of our career. To have that knowledge in order to guide us, I think is just such an advantage.
Earned isn't just about giving us financial advice. They're about doing the things that are needed to be done in order for you to fulfill your financial plan that they have created with you. And that really was very meaningful to me.
Earned is kind of like the conductor of an orchestra. You pull in the trombones, you pull in the trumpets, you pull in the percussion. But Earned is the one that's holding the baton. I feel trust that they're taking care of my entire financial picture, not just one little part of it.
As a physician, I know that what I do for people is really powerful and impactful, and it's important for me to know that the level of expertise that I'm working with for my financial health is there, and I have that trust for them.
It's definitely valuable because I don't have to go looking a million different places. Like, I don't have a lawyer over here, and I don't have, the insurance thing over here. Everything's under one roof.
Earned brings clarity to my financial life.
With Earned, I feel really well taken care of.
I feel my financial health is secure.
I feel supported.
Earned is security.
I would highly recommend any doctor to look at Earned.
I love what I do, and it's really important for me that my patients have the utmost trust that I'm taking the best care of them. I have that same amount of trust with my financial advisors at Earned.
Hello and welcome. We are so excited to have you today. Thank you for joining us for Stop Leaving Money on the Table, 5 tax strategies every physician needs to know. I am Amber Eckerfield, marketing manager here at Earned of Education and Experiences, and I'll be your moderator for today. Today marks a meaningful moment for us. It's our first webinar together since OJM Group became a part of Earned. And over the past year, we've been integrating 2 firms with a shared philosophy that physicians are best served when tax, legal, and wealth expertise operate as one coordinated team. To our clients and friends from the OJM community and those who are joining us from other sources, welcome. The advisors you've worked with for years are here now with deeper resources and a broader bench of expertise behind them. For those of you that are newer to us, Earned is the first fully comprehensive tax and wealth firm built specifically for doctors, their families, and their practices. We bring tax planning, investing, retirement strategy, practice level advice, and fully integrated insurance and legal coordination all under one roof. We are one team that sees your entire financial picture, so every piece works together instead of pulling in different directions. OJM's decades of experience in physician wealth planning and asset protection made it a natural fit. And today's session is a reflection of that combined expertise in the practice. So before we get started, I want to go over a few housekeeping for you. As you can see on the bottom hand right of your screen, or if you're on your phone, you have a chat icon. Say hello, grab my attention if you need any tech help. You also have a questions icon right next to that chat box, and you can insert questions for us at any time, and we will end our webinar with a live Q&A to make sure that all your questions are answered. I have circled apps for today. Some of you might have the button more. This is a super exciting today that we are going to offer you a free tax and wealth checklist for the rest of 2026 so you can really prepare and make yourself financially prepared for 2027. Here's what we're going to cover today, just a little tidbit. Why tax should lead your wealth strategy, the compounding impact of integrated planning versus traditional, very siloed approaches, tax loss harvesting and action, the 5 tax strategies, common pain points, how to solve them, the way that high income earners most often overlook, and untapped wealth potential, which is auditing your own plan, the questions you need to ask your advisors, and the gaps to look for. And of course, again, we're going to wrap up with a live Q&A and a way for you to download that free tax and wealth checklist. So we're excited to have David and Carson with us today, and this pairing reflects exactly what our combined firm offers. David's legal and wealth planning background from OJM Group, along Carson's tax and advisory depth at Earned. They work together as one coordinated strategy. It's the same integration we're going to make the case throughout today's session. David Mandell is an attorney, wealth manager, and partner at Earned, and one of the nation's leading authorities on physician wealth planning. He's a co-founder of the OJM Group, and David spent more than 30 years helping doctors build, protect, and preserve wealth. And he's the author of more than 15 books written specifically for physicians, including his latest, Wealth Strategies for Today's Physician, a multimedia playbook. And he also hosts our Wealth Planning for the Modern Physician podcast and has been featured on Financial Authority on Bloomberg and Fox TV. Joining David is Carson Henderson, Senior Wealth and Tax Advisor at Earn. Carson's expertise sits at exactly the intersection we're covering today, where tax planning and wealth management meet. For more than a decade, he has advised hundreds of medical and dental professionals on advanced tax planning, practice ownership, and pre-sale and selling strategies, helping doctors reduce unnecessary tax exposure and keep more of the wealth that they've built, especially heading into a practice sale or major liquidity event. So, David, before we dive into these tax strategies, I'd love for you to share your perspective on the combination of how OJM Group and Earned, and also the way that we do our tax-led wealth strategy. Welcome on.
Can you see me, Amber?
No, turn that video on so we can see you. We'd love to have you in full focus.
Yes, we do want that. I know. And
always tech things, look at the bottom of your screen, see if you can click on that camera button.
Unfortunately, it went off. That is
all good. Even if we can't see you at the moment.
Yeah, well, you can see my picture and you know what I look like. So I will make my comments. Now, first of all, thanks for having me on. And for anybody who is here from the OJM world, you know me, and those of you who don't, as Amber said, as an attorney and then a wealth manager, originally part of OJM and now part of Earned, I've been doing this for 30 years. And one thing that has not changed over 30 years is that the leading question, the leading challenge that docs, when they raise their hand at lectures that I give or on the podcast or anywhere, is how do I save taxes? So that's why one of the reasons why we wanted to lead with taxes as our first webinar, and Carson doing that, is because I know this is the number one topic that docs are interested in. And I think that's reason for that is really twofold. One, I think there's a real sense for most physicians, dentists of any area of medicine or dentistry or in general, which is that they're not getting proactive tax advice. I hear that over and over and have for decades. Yeah, my CPA helps me a little bit with tax preparation. I get the returns in, but they're never coming to me with proactive ideas of how to reduce taxes, i.e. 5 tax strategies that every physician should know, which is what Carson's going to handle. Even those that don't have that complaint, almost all have the second one, and most of them have both, which is, even if I'm getting what I think is decent tax advice, it's fragmented. I'm getting it from one source, and it's not really integrating into my wealth planning, my investment planning. There's no conversations going back and forth between my tax preparer, tax advisor, CPA, and my wealth manager or my insurance person or my attorney. Everything is siloed. Okay. And this is a common story. They have a CPA, files a return in April or in October. They're looking backwards. The financial advisor may be looking forwards. The estate planning attorney or asset protection attorney may be doing a combination of both, but nobody owns the whole strategy. Many of you probably nodding your head. I can't see you, but I'm guessing that you are. And you're in the top federal tax bracket. Many of you have state taxes, you have Medicare surtaxes. And you know, combining with this problem that we're not getting good advice, not getting integrated advice, is the issue that taxes are your largest lifetime expense. Scary to hear that, right? But it's true. Bigger than your mortgage, bigger than your kids' education. Yet oftentimes taxes are not proactively dealt with. It's a backwards looking endeavor. And as I've tried to make the point a number of times, which I will continue to, it's not integrated. Okay. So here's what I want to reframe for you in the next hour. And as Carson does this, taxes shouldn't be the afterthought of what happens after wealth decisions are made or something that we deal with in the end of the year. It should lead. Every meaningful financial decision, how you invest, what you sell, your asset protection planning, how you give, when you retire, has a tax consequences. And when that happens in silos, small inefficiencies compound over decades. But the good news is, if you do this right and you coordinate, that coordination compounds also. So a percent or two of tax drag that's avoided over 10, 20, 30 years can be a 6-7 figure difference in the end. Now, again, back to those who know us from OJM Group. For about 18 years at OJM, we did a pretty good job helping clients with taxes. With my partner, Carol, who's also a CPA, leading the way, and our entire portfolio team being very tax focused. But one of the reasons we became part of Earned last year is Earned was, and I say they, so far advanced, and now I can say we, in terms of what we are doing for clients in an integrated way to help them tax optimize. We're doing it in a way here at Earned that we never could at OJM. And in fact, for my own personal planning, I've already implemented a couple of the tax ideas available to me at Earned that I could not access it at OJM. And that's why I'm so excited to bring on Carson. Carson is going to make this in concrete. He's going to get into those 5 tax strategies. He's going to show you what the consequences are of doing that planning and potentially not doing that planning and why it matters. So I'm very excited to introduce Carson. Carson, take it away.
David, thanks. Very good introduction. And I think we could end the seminar right now and everybody would be happy. But let's give them a few of these tidbits that they can take home and apply in their financial lives. So appreciate that. So jumping in, we're looking at the cost of fragmentation by the number. So there's just as David already alluded to, your single largest expense through your career is your tax bill. And physicians, dentists, medical professionals, you are in a unique financial challenge, which is this very large tax number that hits you every year. So on average, federal taxes paid by physicians in 2024 was $87,000. The average state taxes paid was an additional $14,000. So that's over $100,000 annually to Uncle Sam and your state. On average, physicians end up in the second highest tax bracket, which is the 35% bracket. There is a higher bracket at 37%. But on average, you're ending up in that 35% bracket. So how do we as advisors, using our skill set, help you reduce these numbers? And as David mentioned, those numbers compound over time if we can take those savings, invest them, and let the markets do the work for us. So jumping in, there's a lot of healthcare professionals out there that are 1099, or they're not paid as a W-2 employee. Now, many 1099 professionals often pay more in taxes than they should. And it's partly due to the tax system where you end up having to pay an additional 7.65% in self-employment taxes. Compared to your W-2 peers, that number gets paid by your employer. Now, the other complexities with 1099 professionals is there's no employer withholdings. You have that additional self-employment tax, and there's no automatic benefits. You don't get to opt into health insurance, or you don't get to opt into a retirement plan. And then the other complexity is nobody's making those tax payments for you via W-2 withholdings. And so you've got to make sure that you make a regular payment on a quarterly basis. So now this shouldn't be the case. If there's any of you out there that are 1099 employees, there's a lot at your fingertips that we can do to reduce that taxable income liability or that tax burden. So for you 1099 folk out there, so what? There's no employer withholding. You manage your own tax payments. You do pay self-employment taxes on top of your income tax, but we should be able to drive down your tax burden using some simple strategies that we'll talk about next. So jumping into that next slide, the three major levers that a 1099 professional should be utilizing is lever number one, your retirement plan. You can contribute up to $72,000 annually through a solo 401k or a SEP IRA. So this again directly reduces that $200,000, let's say, income that I was showing on the previous slide. Now your taxable income is only $138,000 or $128,000. So, again, we just significantly reduced your tax burden. Lever number two, your business deduction. So using a home office, your malpractice, CME, and getting creative about where you're taking your CME and travel, licensing, equipment, and so on and so forth. And then last, there's a third lever, which is entity structure. So there's a certain point, and again, I'll get into it in a further slide, but at some point we stop being sole proprietors and we add on to an additional entity layer, which we call an S corporation. And that S corporation further helps us reduce any tax liabilities that may be incurred by a sole proprietor. And so these are a couple of levers for you self-employed individuals, you 1099 folk. These are some ideas to kind of take away from this seminar. Additionally, on the estimated tax payments, we typically talk about three accounts, and there's account number one, which is kind of our tax reserve account. Any dollar that comes in, we're taking 25% or 30% of it, and we're moving it into our tax reserve account. And that's just so we're kind of out of sight, out of mind. Hey, I'm not touching money that's in that account. That's going to my tax bill. Account number two is kind of your operating account, your business operating account. Usually we like to maintain there 1 to 2 months of cash reserves. And then account number three is pay yourself. So you need to be pulling out a chunk of money every month to pay your personal expenses and to support your lifestyle. That tax account, every so often, we're going to drain it and have you make estimated tax payments. April 15th, June 15th, September 15th, January 15th. And the reason why we're doing this is because we don't want you to incur an extra unnecessary tax payment. And that extra unnecessary tax payment is a penalty or interest to Uncle Sam because you didn't make proper tax payments. And this is one of the single largest expenses that we help our clients, mitigate is we never want to give Uncle Sam more than he deserves. And so, just making sure that we're staying on top of our liabilities when they're due. So I'm going to change focus here a little bit and talk about the 5 major tax strategies that we utilize and implement with our clients. And this is whether you're W-2 or whether you own a practice or whether you're a 1099 independent contractor. Strategy number 1 is proactive planning. Like if you're going to your CPA and it's April 15th and you're talking about, 2025, you've already missed the boat. There's nothing we can do as tax advisors to help you plan and reduce your tax liability. The year's over and you're basically set in stone. And we as CPAs become what you call historians, right? All we're doing is plugging in the information from last year and telling you what your tax bill is. So the best time to start thinking about taxes is today, right? Is 6 months, 9 months before the year's over, because now you're giving your advisors the tools to be able to advise you on how to proactively reduce your tax bill. And we think we can help you, again, implement strategies today that are going to minimize that tax bill next year. Strategy number 2, if you're 1099, basically you're the employer, right? So employees are only allowed to fund, if you're under age 50, you're only allowed to fund your retirement plan up to $24,500. If you're over age 50, you can do $32,500, right? Now, you as a 1099 employee, you can take that number significantly higher. You can take it up to 72,000, or again, over age 50, you can take it up over 80,000. So, there's the trade-off of being an employee versus being an employer or a 1099 employee, where you're able to significantly increase your retirement plan contributions. So just already talked about that a little bit. A W-2 clinician can do 24/5, 1099, and I capped it at 80,000. But really, depending on how much income you're receiving from your self-employment, that number can grow significantly using what's called a cash balance plan or a defined benefit plan, where we can contribute up to upwards of $300,000 into your retirement plan. Here's kind of the breakdown of where we can fund or how we can fund our retirement in kind of those tax deferred buckets, right? So there's an annual limit of $7,500 by funding either a traditional IRA or a Roth. You can't do both, right? You've got a personal limit of $7,500, and then there's a catch up for anyone that's over age 50 that can do an additional $1,100. For those self-employed individuals, you can do something called a simple IRA. And there are circumstances where a simple IRA makes sense. And that gives you instead of getting that 23/5 or the 24/5 on the 401k, it allows you to fund $17K and then also an additional employer contribution of 2 to 3% on top of your deferral amount. The SEP IRA is also good for self-employed individuals. That one gets rid of the 401k feature, and instead you can fund 25% up to 72,000 of your self-employed income. And there are circumstances, again, when SEP IRAs are appropriate. Now, I would say the use cases are less and less these days, and I would probably recommend jumping you straight to a 401k plan or a solo 401k, where we can get to the same $72,000 a year. But then we can also utilize other strategies like, and you hear the buzzword, a backdoor Roth strategy, whereas the SEP IRA kind of ruins that strategy, but a solo 401k can help us be able to manage that and implement a backdoor Roth strategy. And then lastly, you can see the big bucket there, the cash balance plan. So again, in certain circumstances, there's age demographics and income levels, but that can be a significant boost to your retirement plan. And so that works in definitely in some certain circumstances. Strategy number 3 is using tax diversification. And what that means is for your retirement plan, there are different buckets that we can fill to help you optimize that plan. And those buckets are tax-free, right? So you hear about the Roth accounts when you're in retirement and you want to pull money out of a Roth IRA. That money comes out tax-free. You don't pay Uncle Sam a dollar of any of that money that you put in, nor do you pay anything on the appreciation. There's tax deferred. So tax deferred are, things like your 401k, where if it's not Roth, it's what we call a traditional 401k. You get a tax deduction today, and you're going to pay taxes on that earnings or that growth in the future. So when that money comes out of your tax deferred bucket, that's when you pay your tax bill. And then lastly, the last bucket is your taxable bucket. So that's money where, you're taxed on it today. Let's say you make whatever it is, $10,000, and you're taxed on that 10,000, but then you take and turn around and you invest that 10,000 into a taxable brokerage account, right? That money you're taxed on every year. So any interest or dividends that come out of that taxable bucket, you get taxed on it in the current year. But you have basis in your investment. And so using that basis, you can trigger some gains or some losses over time that we can utilize as a tax asset, or, can cost you additional tax liability. Now, these 3 buckets are important. I have some clients, or I had a circumstance of a client a couple years ago who only had tax deferred money. He retired, and that tax deferred money, it was a pretty significant chunk of money. But he wanted to buy a second home. So the only lever we had to pull from was that tax deferred lever. Now, what happens is it becomes this circular calculation that, hey, I need $1 million out of my account to buy a house. Well, every dollar that he was pulling out, it was triggering, basically a 50-cent a tax liability between the Fed and the state. He lived in California. And so for every dollar that he pulled out, he owed 50 cents in taxes. So now, as you can see, it's a circular calculation. So if I need $1 million, okay, I pull out $1.5 million, and that 500,000 would go to my tax bill. But now I pulled out $1.5 million, so I needed an additional 250,000 to pay that tax bill. So now I got to pull out, $1,750,000. But again, it just became this wheel that we were chasing, that we had to really help kind of tune in, his tax bill. It ultimately ended up having to take out $2 million to buy a $1 million home, because, the other $1 million went to taxes. So again, this is why it's important. If we had money in a tax-free bucket, or we had money in a taxable bucket, there were other levers we could pull from to not have to trigger, such a significant tax bill. Tax strategy number 4 is turn business expenses into strategic tax leverage. So again, if we have our own practice, our own business, or we're working as locums, or we have, sole proprietor, we're working as a independent contractor, associate, some other offices, then we can utilize that income to use some of our personal expenses to reduce our income, right? So a home office allocation, right? An accountable reimbursement plan. One of the major strategies we use for our practice owners is what we call the Augusta rule. The Augusta rule is aptly named after Augusta, Georgia, where every year they have the Masters. And the individuals in Augusta, Georgia, they actually are out of school. They go on vacation for 2 weeks. They all move out and go to Disneyland or whatever they want to do. But they rent their homes for those 2 weeks. Now, the really strange thing about the tax law is that if you rent your home for 14 days or less, it's actually non-taxable income to you. So strange tax rule. So again, those individuals rent their homes for 14 days. All that income that they receive from, the golfers that go down there, or the sponsors, or the fans, right? None of that income is taxable to them. So we utilize that with our practice owners, where we have their businesses rent their homes from them for board meetings, or holiday parties, or whatever it is, that we can have that be a deduction for the business, but non-taxable income to the individual. Additional to that, CME, licensing, professional dues, technology, all of those, your cell phone, because you're on call, all of those are deductions for our 1099 or our practice owners. And so making sure that you're optimizing all of those expenses, and we're reducing your taxable income. I would say CME is the key there, right? I mean, you can take CME courses anywhere. So why are you taking them from your hometown? Why not actually find courses that you can travel to, and we can give you the rules around, traveling, where you add on days before or after a CME course, and all of that travel ends up being tax deductible. So, again, there's ideas there where you can get some mixed business and pleasure, see some towns that you've never seen before, and get those CE courses. Strategy number 5 is optimizing your 1099 structure. So choosing the right structure, rather than being just a sole proprietor. There are, better opportunities out there in terms of electing to become an S corporation. It can significantly reduce your tax bill. So by setting or electing to become an S corporation, now you're changing your income stream. Part of that you're going to take out as W-2, but part of that's going to be flow through profits that's no longer subjected to self-employment taxes. And so again, now we can implement things like an accountable plan. We can add things like the Augusta rule, and we can significantly reduce kind of your strategy just based on making the right entity structure election around your self-employment income. So what an S corp does, it again, as I explained, it splits your income into salary and distribution. So it's going to reduce a portion of that a portion of your income that's subjected to that self-employment income or self-employment tax. And so that's where, again, we can minimize some of the tax bill there. We can also add accountable plans, Augusta rule. It gives you some liability protection. But what it doesn't do is it doesn't lower your income tax rate. It also, doesn't make personal expenses deductible. Obviously, there has to be a business reason behind any deductible expense. It doesn't eliminate audit risk, and it doesn't always make sense. And so in our next slide here, there's 2 things when you do become an S corp. The only audit I've seen in the last 7 years is a reasonable salary audit. So all you S corporation owners or corporation owners, you have to make sure you take a reasonable salary. If you don't, then it's really low hanging fruit for the IRS to pick out your tax return and see, oh, look, this person is an S corporation, didn't take a salary. I wonder why they didn't, right? And so it's a really easy, low-hanging audit risk that you probably should not subject yourself to. So basically, from a reasonable standpoint, you need to take a salary that supports your job duties and your work hours. You got to take a fair market compensation. If you're a brain surgeon and you're taking $50,000 as a wage, that's probably not fair market compensation. And then you can take consistent payroll throughout the year. It just kind of sets you on a budget. And again, just making sure that you have clean books and records for your S corporation. Our general rule of thumb is that anybody under, making under 75 to 100,000 is probably not worth it. As you can see, yeah, we can save you about $3,800 in tax, but at the same time, you have extra administrative costs, right? So now you've got to pay me to prepare a tax return. That's going to cost you, let's say $2,000. Now you've got to be compliant, right? So you've got to start taking payroll. That's going to cost you a little extra money. And so usually at that 75 to 100,000, it doesn't necessarily make sense. There are circumstances where it might, but our typical rule of thumb is not worth it. Typically in that 100 to 200,000, that's when it starts to become more compelling. And then above 200,000, it's kind of a no-brainer. We think we can easily save you more than the additional administrative cost to run as an S corporation. So now we're jumping into some of the kind of the untapped, or these are kind of the soft, not as finite, I would say, wealth strategies. So again, taxes are your single largest expense, right? So, in California, New York, New Jersey, your top combined rates between Fed and the state is above 50% or can exceed 50%. And so, if you're not coordinating your wealth management with your tax advisor, we think there's a lot of missed opportunities that, can save you over, in this study here, save you $600,000 difference on a coordinated effort between the different advisors. That, again, we want to make sure we're just out there doing proactive planning rather than reactive management of your tax situation and your financial plan. If we're doing those together, we definitely think we can help you. So there's a couple of case studies here. Many of you out there are either a practice owner or you own some real estate. Historically, the conversation has been, hey, I want to sell my practice. And it's like, well, tough luck, bite the bullet. Let's just pay the tax bill. Within the last couple of years, and this may be one of the strategies that David alluded to, when you sell a business or you sell real estate, there's a capital gain associated with that transaction. So here's case study number one. This is a client of mine. This client owned multiple imaging centers in Utah. He was making a very good income, making about $1.4 million per year between W-2 and then that kind of flow through profit that we talked about when you have an S corporation. He got an unsolicited offer for his practices. That offer was $10.5 million. So really no deal sourcing support. Came to me and said, hey, what do I do? How do I help myself from a tax perspective to minimize the gains here? Two things here. He was going to get $4.5 million in 5 years. He was going to get $6 million at close. So how can we reduce the tax burden on the sale from all the capital gains taxes? So here's what we did on the right side. So on the right side, we funded a $3 million brokerage account with that $6 million that he received at close. In that first year, and this is one of what we call our tax loss harvesting strategies. In that first year, and it's a big misnomer. We're not investing in losses. We don't like losses. Your money's not going down. And so like the next slide will kind of show you that. But in that first year, we harvested off of his $3 million that he had funded there. We harvested $411,000 in losses out of that brokerage account. That alone in that first year saved him $130,000 in taxes. So huge savings, paid for itself. But look what's happening over the next 5 years. Over the next 5 years, we're going to be able to harvest $4.5 million in losses that we will offset the complete gain on that $4.5 million that he receives in year 5. And that will save him $1.125 million. That'll save him 25%. Actually, it's 30% between the Fed and the state. It'll save him on his tax bill. So again, I use the term losses. Let me show you what happened to his brokerage account. So this is his brokerage account. He invested in September of 2024, the $3 million. October went down a little bit, went down 91,000. November was the first year that we harvested, or the first month that we harvested any losses out of. And in that month, his portfolio balance was that $3,012,000. So it had rebounded from its October losses and started to appreciate. And so in November, we harvested 211,000. In December, we harvested, that's where we get to that 411. We harvested another $199,000. His brokerage account at the end of December was at $3.1 million, almost $3.2 million. So as you can see on a go forward basis, January is at 3.4, February kind of hovering around that 3.6, March, again, we start talking tariffs and wars and all that other stuff. We're down to 3. But by the end of December 2025, his portfolio balance was sitting at 3.885. And up to that point, we had harvested $2.4 million in losses against his portfolio balance. So this is what we call our accelerated tax loss harvesting strategy. This client is forever thankful, calls me and says, hey, the portfolio is doing great. I love that we're offsetting taxes. So awesome strategy for this client. This is a second client that used the same strategy. This one actually started in advance of his practice sale, started 6 months before. And ideally, with anybody that's got a transaction that's in the future, the ideal time to start doing a loss harvesting strategy is today, rather than waiting until the transaction happens, because a lot of times we can't harvest enough to offset your gains in time. And so if we can start sooner than later, we can definitely set you up for success. But this client was an orthodontist in the Bay Area, sold his practice for $1.6 million. We started investing in December of 2023, started with $1.7 million in his portfolio. By the time we had gotten to transaction date in June of 2024, we had harvested $175,000. But from June, after his practice sale, he invested an additional 1.1, taking his brokerage account over 3 million. And between July to December, we harvested another 1.23, so another $1.2 million in losses, where we were able to offset $1.4 million in gains on his transaction. So we saved this client $400,000 in taxes by using that same accelerated loss harvesting strategy. And you can see, again, the slides of where his portfolio balance was. June, taking him over that $3 million mark, end of December, portfolio's at 3.3. In end of December 2025, his portfolio was over 4 million. I wanted to show this highlight in November was actually another strategy we use, and I'll talk about this a little bit later, but it's where we take appreciated stock positions and we do charitable donations. And so that highlight in November of 2025 was portfolio didn't necessarily go down that month. That was a month when this individual donated a portion of their portfolio of appreciated stock, which again is a really good tax strategy, and I'll talk about that here in a minute. But 2 case studies. So these are hypothetical kind of average capital losses that we can harvest on an account. If we just do a direct indexing account, year 1, we can get about 17%. By about year 3, it's run its course if you're not adding new money, but somewhere in that 28-30% of the portfolio balance we can harvest on a client account. Using these other models, the Flex 1 in 45 or the Flex 200, that's where we can really start to accelerate some loss harvesting. Again, we can use those losses to offset gains on real estate sales, or concentrated stock positions, or practice sales. Backdoor Roth strategy. So high earners typically can't contribute directly to a Roth, but they can contribute to a traditional IRA. We can convert it to a Roth, and then we can get that tax-free growth on it forever. There are some gotchas there. You can't have any balances in an IRA, in a traditional IRA, or a SEP IRA, or a simple IRA. So we've got to make sure your accounts are clean, and so clearing up basis usually becomes the strategy there. Smart asset location. So asset location is something that some advisors talk about, but not everybody. There are more tax efficient portfolios, or there's more tax efficient investments, and there's less tax efficient investments. So, we want to locate those less efficient investments in things like tax deferred accounts, and those more efficient investments in your taxable brokerage account. And so smart asset location is definitely something where we think we can add what David alluded to was tax alpha, or reduce tax drag. So those are definitely keys to building a successful kind of financial plan. Next, I alluded to earlier, something called a donor advised fund. And what that is that's where you have, you can do charitable donations many ways. But for those that are under age 70, you can do cash, but cash donations are the least tax efficient donations you can do. So the most tax efficient for those under age 70 are contributing those appreciated stock either directly to the institution, right? Or you donate that appreciated stock to what's called a donor advised fund, and then you write checks out of your donor advised fund to your charitable organizations. So why is that tax efficient? Well, let's think about it this way. If I have an appreciated stock position, let's say I buy Apple today for, let's say I buy $10,000 of Apple today, and a year from now it's worth $20,000. I could sell Apple and I could write a check to my organization of choice, right? But what I did in that transaction is I just sold and I triggered a $10,000 gain. So I no longer have $20,000 to donate. I've got to pay, again, depending on your state, that could be upwards of 35% in taxes on that $10,000. That's a $3,500 tax hit. Well, rather than sell it in your taxable brokerage account, donate that to a donor advised fund, sell it inside your donor advised fund, then write your check. You basically just donated away your $10,000 gain. You get full credit for your charitable donation of $20,000, but you don't have to pay that $3,500 tax bill, right? So kind of a simple strategy there. For those that are over age 70, there's an additional thing called qualified charitable donation. That's really the most effective. Feel free to connect if you're in that category, and we can help you make the right choices there. And then kind of the last slide, David alluded to the compounding effect, right? What if you could save $25,000 a year in taxes? How much would this be worth to you in, let's say, 10 years? After 10 years with the compounding of 8%, that $25,000 per year ends up being $391,000. If you can do that for 20 years, that becomes 1.2 million. If you can do that for 30 years, that's $3 million in savings that's in your pocket that otherwise would have been in Uncle Sam's. And so the compounding effect of smart, efficient, tax planning is significant. And so with that, kind of jump over to happy to connect with anybody that is interested in learning more. There's other strategies we can utilize, but either David or myself, we'd be more than happy to connect and see how we can help you in your individual situation.
Carson, that was wonderful. Thank you so much for going through all that knowledge. Really good tidbits that I think they can help implement today, and then reach out to you if they have any more detailed questions. So again, this is Carson's contact information. And as Carson stated, we are for you. We are for your practice. We have everything under one roof. And if you would like to book a consult with us, you now have on your screen that button to click, and you can book a free consult here with Earned and get connected with Carson as well. David, you're back on. I know we have our Q&A, but really what I'd like to do is go over some key takeaways. That was a lot of information. Let's see if we can kind of give a good synthesis of all that.
Yeah, I would say, one key takeaway, and the reason we kind of organize this talk and the slides this way, and when I do talks also I do it, is there's something here should be for everybody, meaning that if you're employed, there's some ideas here on your personal tax planning, this tax loss harvesting, accelerated tax loss harvesting, etc. If you have your own practice or you're doing some side hustles or some business, some work that at this point maybe is just 1099, but could be an entity, could be an S corp, could be some of the things that Carson was talking about, then there's something there for you. If you're a partner practice, then the decision of what kind of plan to do in terms of qualified plan, is it a defined benefit plan, is it something else? The decision to be an S corp or be a C or change that, that'll be with you and your partners, and there's that for you. So we typically do the thoughts, put these 5 strategies here, so there's something for everybody. And in fact, for some people, there may be more than one. But that's one comment I want to make. The other thing I wanted to just say is, and Carson knows this very well, but when we joined Earned at the end of the year, we had a lot of folks in the OJM world who had asked over the years, hey, can Carol do my taxes? Can she prepare them? She's doing a great job analyzing. And she, for the most part, said no, she just didn't have the capacity, etc. And then we became part of Earned, and it was, the absolute worst time for Carson and all his colleagues to have conversations about this, because it's January, February, March, and into April 15th. It's the busiest season of the year, tax season, right? So this is more of a comment than a question, because I think I know the answer. But it's, when is the time for people listening to this to start really being proactive on perhaps getting a second opinion, perhaps thinking about a different tax, and accounting relationship? And I'm guessing this is a good time to do that, because before you know it, it'll be end of year and you guys will be slammed. I'm saying you, me, and Carson, and there's just so much to do that. So people listening this, watching this, and some may be watching the recording, this is the time really to spend a little time on your financial life, not just in it, and have these conversations with Carson, some of our colleagues. But Carson, you concur this is a good time for you?
Yeah, for sure. Yeah, 100%. It's better now than end of year or beginning of the year when we're neck deep in tax returns. I would say, we can do an analysis on your tax return and look at, we use tax drag as a term, but that's essentially, how much more in taxes are you paying because of how your investments are allocated, or your charitable donations, or did you miss doing, you know, the backdoor Roth conversion? And so we can analyze each individual tax return to determine, you know, opportunities for improvement, and then either help you improve those, or, you know, again, give you ideas about how to improve your circumstance.
Awesome. Great information. We don't have any questions today, but I will say that a lot of people are asking for the replay link. Either they had, you know, patients today or couldn't make the full thing. So really excited that you were enjoying the content and you want to take another look at it. Thank you again, Carson. Thank you again, David. Really excited to be talking about these tax strategies today. And thank you to our audience for joining us. And we will see you next time.
Thanks.